Meanwhile, Federal Reserve Chairman Jay Powell is set to speak at the Wall Street Journal event this afternoon on the state of the economy. We are waiting to see if he says anything about this backup in interest rates. Joining me right now is Lane Generational founder, managing partner, and former Raymond James vice chairman, Fred Lane, this morning. Also joining the conversation all morning long is Fox Business's Dagen McDowell and SureVest CEO Rob Luna. Great to see everybody this morning. Thank you so much for being here. Fred, thank you for being here. This market rolling over on technology as interest rates move higher. How do you play this? What's your take on these most recent events in interest rates backing up?
Well, we're frankly delighted because I know it sounds like a strange thing to say, and I don't mean that in quite the perverse way it sounds, but we have been sitting in cash for about 30% of our holdings for a good long time here, going all the way back to late February and March, at which point we were 40% cash. And the difference between 40 and 30 was the appreciation in the remaining part of the portfolio. So we are looking forward to putting money back to work in the technology space. I know the conventional wisdom is you don't want to invest in technology when interest rates are rising because of the long tail of future earnings and their multiples. But as the multiples come down, the top line growth of technology stocks becomes a compelling factor. So we're big on secular growth. So everything related to secular growth is where we want to put our money. If you have to pay a bit of a premium for that, so be it. But the premiums are coming down. So we actually like what's going on. As I've said to many clients and others, I love the companies in our portfolio. I do not like their valuations particularly. And the market is now cooperating.
Yeah. And the valuations within tech in particular have been soaring, right, over the last year or so, and that's where the slump is. The major players dragged down the NASDAQ 3% yesterday. The NASDAQ now on track for a third down week in a row. This is the longest losing streak here since September. Fred, do you see values here, or are these stocks still expensive? Because I know you're looking at, several percent lower, but you're still, comparatively speaking, very high priced relative to where they were 2 years ago.
Well, one thing I've learned about in my 44 years in the market is that time in the market matters a lot more than timing the market. However, if you're going to put money to work, finding a good entry point is good, and it is certainly advantageous, and that's what we've been trying to do, and I think it's cooperating with us. We're seeing better values. We're also seeing there are still smaller companies, mid-cap companies that represent good value and good growth prospects, some of which are relatively undiscovered. One of the areas that is starting to give rise to opportunity, and it's not here yet in our view, because there's still a lot of speculative interest in these stocks, but there's so many SPACs that have been formed that we're going to start looking, and we've already started to look through that list of companies, and there are some that are very fully and aggressively valued and fairly frothy, and there are some that frankly look pretty interesting. And as those drift lower and fail to, in my view, get the research support that is associated with companies of that size, I think they'll provide some really good opportunities for us as investors.
And are those specific situations, Fred, or are they sector calls?
They're actually specific situations, but most of them are they're not going to relate to electric vehicles in all likelihood. That's been the most frothy area. But some of the SPACs that are focused on communications technology, on media, and in other spaces, I think are going to be interesting. But it's very selective. It's very specific to the SPAC itself and the sponsor. In many cases, we know the sponsors. I was actually approached recently to do a SPAC because people looked at my background and said, "Gee, Fred, you have this extensive investment banking background as well as investment management and extensive private equity background. You should be a sponsor of a SPAC." But I basically said, "Gee, it's a 2-year exercise." And a lot of the money that's been raised and is being raised to date, that money has to be put to work. It's a long and hard process. And I don't want to, even though the sponsors can be easily critiqued for, their carried interest, their free stock, quote unquote, I think it's important to realize that it's a 1 to 2 year intensive exercise competing to find the right vehicle to acquire. And that's a very hard exercise. Yeah. It's not for me as I'm running Lane Generational.
Fred, let me ask you this. As interest rates have gone higher, stocks have gone lower as interest rates bounce, certainly in the 10-year and the 3-year as well from the bottom. But we're talking about 1.478% on the 10-year right now. Does this represent competition in your view for stocks? I mean, what is the level that could be a problem for the stock market?
I think when it's so funny. Thank you for asking that question. I just looked at that actually, and I was curious. The last time we saw the 10-year at something approaching 3.25%, and it was, I think it was 2.5, 3 years ago. I think it was in August or September of 18, as I recall.
Yeah.
And then it was 3.5%. There was all sorts of conversation about inflation, and I remember being on a media outlet and saying, we're not having inflation. Okay, the inflation is not occurring, and technology is deflationary. And, you know, the other speaker was saying we're going to have a 4% 10-year. And I said, no, we're not. And in any event, let's leave that alone. But the point is that I think it's going to take quite a bump from here to really compete for stocks and drive stocks lower. At 4 to 5%, now you're starting to get to the point where long-term investors are going to consider the bond alternative. Right now, I think, and Wall Street's been very slow. Money managers have been very slow to this conversion. It's pretty well established that a 60-40 portfolio, equities, bonds, even for an older retiree, is not an appropriate allocation because you're not going to make much of a return in bonds. And worse, you have tremendous market value risk. You know, the thing we're wrestling with is, you know, we live in the best of all worlds, to quote Dickens. We live in the worst of all worlds. We live in the age of reason. We live in the age of incredulity. And, you know, it really is a winners and losers economy out there. And so many sectors of the economy have been battered, and so many sectors of the economy have been great beneficiaries of what's gone on, even within the same sector, within retail, right? We all know the winners and the losers. And so, you know, our job is to figure out who are going to be the persistent secular winners and who are going to be the losers. And it's fairly, it's not always obvious, but it's fairly obvious. And then there are the outliers where a GameStop gets so cheap, people think, well, gee, it's a great opportunity. And at $4 or $5, it might have been, but at $25 or $30, not so sure. We certainly didn't think so. And of course,
all right, Fred.
That history is its own history.
It is. Fred, it's great to see you this morning. Thank you so much. We will talk soon.
Thank you, Maria. Nice to be with you.
Fred Lane joining us.